I just unlocked a billion-dollar business opportunity inside the US-Iran crisis. In this video, I'm going to walk you through the hidden business opportunities inside this crisis that 99% of executives completely miss. We don't like violence, but what can we do? I'm Addie Choy. Now I'm an official mentor appointed by the government. I spend my time decoding what most people can't see. The policies, incentives, and institutional access inside China that quietly turn uncertainty into real competitive advantage. So in this video, I'll walk you through three things. Number one, how the Iran shock actually strengthens China's economic position instead of weakening it. Number two, three concrete China-based plays you can use to protect your margins when oil, shipping, and interest rates are all over the place. And number three, how to use Hong Kong and mainland China as a profit hedge, not just a risk, over the next 12 to 24 months. Hit subscribe now. Every week I turn geopolitical shocks into practical China strategies that print money for Western executives. So you're not just reacting to headlines, you're turning them into growth. Let's start with what actually happened. After the latest US strikes on Iran, oil prices jumped as markets started to price in disruption around the Strait of Hormuz, the narrow route that carries a big chunk of the world's seaborne crude. If you're running a business in North America or Europe, that shows up as higher input costs, more expensive logistics, and investors pulling back into safe assets while they figure out how bad this gets. On paper, China should be the biggest loser in this situation. It's the largest crude oil importer on the planet, and a meaningful share of its barrels come from the Gulf and from Iran itself. If flows through Hormuz slow down, Chinese refiners have to scramble and pay up for replacement barrels in a tight market. And that squeezes margins in export-heavy manufacturing. But here's the twist most people miss. Beijing has been planning for exactly this kind of mess for more than a decade. It assumed the world would get more volatile, more sanctions, more choke points, more sudden conflicts, and it built its energy and industrial strategy around that assumption. That doesn't mean China enjoys this. It does mean that in a world where oil and sea lanes are no longer cheap and predictable, China's preparation gives it leverage and gives you a set of tools you can tap into. First, diversification and reserves. Over the years, China has widened its list of suppliers, not just the Gulf, but pipelines from Russia and a broader mix of producers in Latin America and Africa. It's also built up large strategic petroleum reserves that it can use to smooth out sudden import shocks. So when something like Iran blows up the risk premium, China isn't starting from zero. Second, renewables as energy security, not just climate branding. China has poured huge investment into solar, wind, electric vehicles, and batteries, and it now dominates manufacturing in a lot of those areas. The more power it generates at home from these sources, the less it needs to rely on oil that has to sail through dangerous choke points. Every extra gigawatt of Chinese wind, solar, and storage is one more step away from being hostage to whatever happens around Iran. Third, all of that has created dense industrial clusters, battery valleys, EV hubs, solar equipment cities, where suppliers, engineers, and logistics are all in one place. For you, that's not a theory. That's a menu of ready-built platforms you can plug into when you want to lower cost or reduce risk. So instead of just saying, wow, China planned well, the real question is, how do you, sitting in Toronto or Chicago or London, actually use what China has already built to protect your margins and grow? Opportunity play number one, turn China's green capacity into your cost advantage. When oil jumps, anything electrified and efficient looks better overnight. Chinese manufacturers already dominate global supply of solar gear, EVs, and batteries. If you run fleets, factories, warehouses, or data centers, this is your window to lock in medium-term supply or joint ventures with Chinese battery, EV, and solar suppliers. So your transition costs are stable while your competitors are stuck buying whatever they can find. In practice, that might mean switching part of your fleet procurement to Chinese EV makers under multi-year deals instead of refreshing vehicles 1 year at a time. Partnering with a Chinese battery company to build dedicated storage for your facilities with clear pricing and capacity so you're not guessing what power will cost. Or working with Chinese solar plus storage providers to secure long-term power for plants where grid prices track fossil fuel markets directly. Opportunity play number two, Use China as a production shock absorber. If all your manufacturing sits in high energy cost markets, every spike in oil and freight goes straight into your gross margin. There's nowhere for that shock to go. China's big industrial clusters and a grid that's shifting toward more stable domestic generation give you a different option. You can relocate or dual source specific products into that ecosystem to smooth out volatility. Here's a simple way to think about it. Step 1. Pull a list of SKUs where energy and freight are a big piece of your total landed cost. Step 2. For those SKUs only, explore Chinese OEM or contract manufacturing. You're not moving everything to China. You're building a China plus one setup. China as the stable base that can keep producing through shocks, plus a second location closer to your end market to balance regulatory and political risk. Done well, your customers don't even see the change. They just see that you deliver on time and your pricing doesn't whipsaw. Opportunity play number 3, capital and deals via Hong Kong and mainland China. Capital is already flowing into Hong Kong as a gateway to China. New investment schemes have pulled in thousands of applications and tens of billions in intended investment, which tells you global investors want structured access to Chinese and regional assets. Combine that with Chinese engineering, construction and tech firms that are already building across the Middle East, Southeast Asia, and Africa, and you get something powerful. Deal vehicles you can join instead of building everything from scratch. Practically, you can. Use a Hong Kong company as the holding vehicle for joint ventures that bid on energy transition and infrastructure projects in regions hit by today's instability. Team up with Chinese infrastructure or energy players as the local lead, while you bring technology, standards, or brand trust to the table. Tap a mix of Western and Chinese capital to fund those projects, instead of depending only on your home market banks at exactly the moment they're most nervous. Let me make this real with 2 quick examples. First, imagine a mid-size industrial company based in Germany or the Midwest. Today it runs one big energy-hungry plant and ships globally. When oil and freight jump, its margins get crushed. After a China strategy, half of the most energy-sensitive components are dual-sourced from a Chinese cluster, with cheaper, more stable power and a complete supplier base, while a Hong Kong joint venture co-finances an efficiency upgrade in the original plant with a Chinese battery and automation partner. Same customers, same product, but the cost and risk profile are completely different. Second, picture an asset-light tech or services firm in the US or Canada. Right now, its projects in emerging markets stall whenever clients get hit with higher fuel costs or tighter financing. Deals just pause. With a China angle, that firm rides into projects as the tech partner to Chinese infrastructure or energy companies that already know how to win bids and line up funding in those markets. Instead of chasing deals alone, you're getting pulled into larger projects because you've attached yourself to a player that's structurally built for this environment. US strikes Iran. Oil and logistics get shaky. Boardrooms get nervous. Because China prepared for this kind of volatility by diversifying its energy, building huge domestic renewables, and creating deep industrial clusters, it now offers something most CEOs don't see: a ready-made platform to hedge your energy, supply chain, and capital risks. The real question isn't, is China risky? The real question is, am I using China's preparation to give my business an edge before my competitors do? To help you answer that, I've created a short China Opportunity Diagnostic for Western executives. When you click the link below this video, you'll answer a few focused questions about your business. Based on your answers, my team and I will send you a personalized strategic analysis where China can unlock billion-level opportunities in your sector, and a practical roadmap for how to enter or expand safely. If you want more than headlines, if you want a clear, customized plan, click the link below now to complete the diagnostic and unlock your China roadmap. And don't forget to subscribe for weekly strategic content that turns geopolitical risk into your China business growth.